Welcome, Kellogg community. I'm Michaela Doyle with the Kellogg School of Management. Thank you for joining us today for our series, This is Kellogg, Credit Scoring with Alternative Data and AI with Eric Anderson. The virtual This is Kellogg series showcases Kellogg thought leadership and initiatives important to the future of the school. You can catch up on prior webinars in this series at our virtual events page on the Kellogg alumni website. We will put a link to that site into the chat now. Today's presentation will last 1 hour, and we encourage you to submit questions for Professor Anderson anytime using the Q&A icon at the bottom of your screen. And we will incorporate audience questions into this discussion as time permits. I'm now pleased to introduce Eric Anderson. Eric is the Polk Bros Chair in Retailing, Professor of Marketing, and former Chair of the Marketing Department at Northwestern University Kellogg School of Management, and former Director of the Kellogg McCormick MBAI program. He holds a PhD in Management Science from MIT Sloan School of Management. Professor Anderson's research interests include analytics, AI/ML, customer loyalty, retailing, pricing strategy, and innovation and channel management. He teaches pricing and retail analytics in the MBA program and marketing analytics in the EMBA program. He is a four-time winner of the Sidney Levy Award for Best Elective at Kellogg. Professor Anderson also serves on the board of directors for Canadian Tire and is an advisor for Lift Lab. Welcome, Eric. Thank you for speaking with us today.
Thank you, Michaela, and thank you for that kind introduction. Really appreciate it.
So we'll get started with your presentation, and then we'll have Q&A for people to submit with questions. But I think we were going to start with the credit scoring aspect, or you tell me.
Terrific. So what I wanted to do today was sort of introduce you to a research stream. So it's several papers that we've published, and then there's several pieces that are ongoing. And it's all related to what Michaela just said, which is using alternative data for credit scoring. And the origins of this paper start with recognizing a problem that exists globally, which is that there are over 1 billion individuals who don't have access to credit or formal credit. And this is less of a problem in the United States, a bit less of a problem in Europe, for example, but is a major problem as you go to, say, South America. And I'm going to show you some of the work we've done in Peru. It's a major problem in other parts of the world where access to credit is difficult. And so you might be asking yourself, why is this such a big deal? And as we've gotten deeper into the research that's now been going on for the last 6 or 7 years, one of the things you recognize is the people who don't have access to credit also often don't have access to formal, regular employment. That means they're not getting a weekly paycheck, a bi-weekly paycheck, or a monthly paycheck. Their pay comes in sporadically. And because their pay comes in sporadically, it affects them quite personally in terms of their access to being able to buy food, pay their rent, and various things. And so they struggle financially when they have these sporadic paychecks. In work we've done in Europe now that I'll tell you a little bit about towards the end, it also becomes particularly severe when you're a single parent. A single mom is a common customer in one of the companies we work with in Europe. And over the summer, one of your challenges is your kids aren't in school. So during the school year, your kids are getting, subsidized lunches and subsidized breakfast, but now you need to feed them over the summer, and you don't have access to as much funding to do that, and so you need additional funding over the summer. And so these become real pain points, and when you hear the stories of how it actually impacts consumers personally, you realize that there is a need for credit, that it allows you to do things that we often take for granted when you have credit, but by having access to credit for many consumers, what it allows you is to smooth through these uneven paychecks, to smooth through these spikes in your family needs more funding to pay for food over the summer, my example from the UK. And so that's sort of the motivation for our paper, is to figure out, can we use alternative data to help consumers get access to credit by getting them sort of credit scores, but in a unique way. The last thing to sort of set up the puzzle is that it's this chicken and egg kind of problem, which is that when you ask what's going on in this market, there are numerous consumers who don't have access to credit. And then you ask, well, how do you get a credit score? Well, you have credit. And so you're in this conundrum, which is you can't establish a credit line until you actually have credit. And so they find themselves in this circular situation where they never get access to credit. And on the lending side, you ask, well, who do you approve? Well, you approve customers that you know about that have scores and that have access to credit. And so if you don't have access to credit, it's difficult to approve you. And so there's this, you're caught in a bit of this trap that it's sometimes difficult to establish yourself as someone that's worthy of receiving credit. So that all prompted us to ask this question of like, well, what else could we do here? And we came across some examples from industry where they had been using alternative data to create credit scores. So we thought, well, can we do this? And so the first paper we worked on was actually in the Middle East with a company that owned a very large grocery store chain that many of you have heard of. And they also owned a credit card company. So it was a conglomerate. And what we were able to do is link together the loyalty card data from the supermarket with the identifying information in the credit card file and merge the things together. And so what that allowed us to do was start asking this question of, well, is there any information in your shopping behavior at a supermarket that might inform whether or not you pay back your credit card bill? Are you going to be always on time? Are you going to be what we call a sloppy payer, someone who misses a payment occasionally, but eventually makes it up? So you miss this month, but you pay it back next month, or you defaulter. So in the world of banking and in credit and lending, it's pretty common to define somebody as a defaulter as somebody that misses two consecutive monthly payments. So if we're sitting here in October and I don't pay my bill on October 31st, that's one missed payment. And then if I don't pay my bill on November 30th, that's a second missed payment. And now I'm called a defaulter. Right. And so we're going to use that definition throughout. It's very common internationally as a definition of default. It's used in many markets. And that's going to be our definition of somebody who fails to pay back their bills. And what we did on our first study was ask, well, can we come up with any ideas about why somebody might be able to repay their bills all the time on their credit card versus those that maybe aren't as reliable and maybe miss payments and become delinquent at some point? And so we started generating hypotheses. And so one of the things we started to look at is, maybe shopping regularly on the same day of the week is what we think of as maybe a good habit, right? So you always shop for groceries at, early morning on Saturdays, right? That's the kind of customer who's maybe very reliable, or maybe Wednesday is your shopping day, right? You always go on Wednesday. But if you're going to the store sporadically, this week you shopped, 5 p.m. on Monday, next time it's 2 p.m. on Wednesday, that's a lot more chaotic. You're not sort of going on a regular pace. And so we asked, could this be informative of, whether or not you end up paying your bills back? And it turns out it is. It turns out that the more reliably you shop, if you have a regular cadence that you show up every day of the week, always on Saturday, always in a narrow window, it's predictive of whether you're going to pay back your credit card bill, which to us was like, oh, that's actually sort of interesting, a little bit surprising. And we started to think about, other reasons or other sort of habits is what we eventually called them that might drive whether or not you're going to come back and pay your credit card bill, right? So one of them was this idea of, do you shop the same day of the week? But we also asked, well, do you tend to shop in the same time window? Like regardless of what day you're shopping, do you always tend to shop at 9 a.m. to 12 p.m., right? Or do you shop, evenings from 6 to 9 p.m.? Turns out that's also informative. So there's all these tiny little signals that come out from how you shop, right? Do you shop on the same day? Do you shop the same time periods? And we also started to look at, well, do you spend the same amount, right? Are you always spending $40 when you go to the grocery store? Or is it this week it was 25 and then the next trip it's 102 and then the next week it's 88? And it turns out that our idea was that if you're coming in and regularly spending the same amount, you probably have a budget. You're probably coming in with a pretty clear plan. You know what your limit is, and you're going to go and spend $40 every week. Turns out that's also something that's highly predictive of whether or not you're going to pay back your bills. The more likely you are to pay back, the more, if you have a budget or you're spending the same amount, you're more likely to repay your credit card bills. And then another thing we came up with was this idea that, do you sort of buy random things throughout the store? Like you walk in and you're at an aisle and you're buying things sort of, sporadically, or do you consistently sort of buy the same brands and the same categories? It turns out that consistency in your buying behavior, whether you consistently buy the same brands, turns out to be an indicator that you're going to pay back your bills. And then one of the last things we looked at was, do you tend to take advantage of deals and promotions? So when your favorite products are discounted, you should probably buy them. When you're in the store that week and the things you normally buy are heavily discounted, you should take advantage of them. And if you don't, maybe it's not a great signal. And so that also turns out to be a behavior that, yep, if when your favorite products are discounted, you buy them, it's a pretty strong signal that you're going to come back and pay your bills on time. Now, some of this we could do without machine learning. But the part where we really needed to sort of get into sort of AI and machine learning is we wanted to ask sort of this question of like, is what you buy, like the items that you buy, can that also be informative? And so this turns out to be a really big problem in terms of data analysis because a typical grocery store might have anywhere from between 40,000 and in some cases as high as 100,000 products. And so it's very hard to deal with this massive amounts of data. And so that's where machine learning and AI really helped us is we were able to, do some things that were clever on the back end in terms of how we engineered our model to take advantage of this and then discover like, well, what are the products that tend to be signals of whether or not you pay back your bills, right? And so, Michaela, I'm going to ask you to come back. Can you guess what the number one thing is that predicts what item you buy in the grocery store that's highly indicative of, whether you're going to pay back your bills? I put you on the spot. But,
Oh, no, I'm trying to
like, what might be a really good indicator that you're going to be a bad customer, that you're not going to pay back your bill? And I'll give you a hint. It's a vice.
oh, I want to say, is it like is it alcohol? Or
So in this case, in the UAE, they don't sell alcohol, but they sell another common vice all the
okay.
time.
Is it cigarettes?
It's cigarettes. And cigarettes, by far and away,
Hmm.
is the number one predictor of whether or not you're going to pay back your bills. And if you buy a lot of cigarettes, you're very likely to default. All right. It also turns out that if you look through the list of things that predict default, I always joke with people. I said, it looks like you're staring at like a 20-something-year-old bachelor who doesn't quite know how to take care of themselves because most of the things on the list are things you don't need to work hard to consume. So, for example, deli meats, canned items that you can just open up and eat, beef that you can just take out of a package and eat right away. And so these don't require a lot of work. You just have to sort of open them up and you can consume them right away. In contrast, oh, go ahead,
Yeah.
Michaela.
I was gonna, because there is an interesting question that came in kind of related to about the purchasing that happens. Are there privacy risk in evaluating people's shopping patterns? Like if they do see people who are buying, certain products, is that a privacy risk for, them or just something that data tracking wise?
Yeah, so I think th this question of privacy always comes out. The reality is that the exact items that go into these scoring models and the exact behaviors that are captured in these scoring models are never going to be revealed to consumers, right? So we're not going to tell consumers like, oh, if you stop buying cigarettes, your score is going to go up. Okay, so that's the first thing that everyone says. Like, if I want my score to increase, maybe I'll just buy my cigarettes in cash and I won't swipe my loyalty card, right? Which is, if I was in that situation, I might do the same thing. Like, take the items that are hurting me and remove them from my basket and just pay cash and buy them anonymously. There is a privacy concern more broadly, though, about can you use this data? But I think what really comes back to is, are you using this data for good purposes or for what I'll pejoratively say like evil? And I think the intent here is to try and use this for good, to try and get access to credit for consumers who want it. And this is their route to getting there, right? And so I don't think consumers who are in the situation are going to come back and say, "Oh, I don't want you using my data. I'm actually glad you can help me get through this hurdle." Right. And so I'll tell you more about the UK project at the end, but when the prototypical customer I described in my introductory remarks, a single mom with three kids that's on uneven paychecks and trying to make things work, and you tell them, you follow this path, we can help you get access to formal credit. I think you're going to have, yeah, you can look at my data. I would like you to have access to my data. So it's an interesting question that comes up, but I think it really depends on how you're using this data for what end, right? You're really trying to help out consumers. Okay. I see another question come in. So is eating deli meat and canned goods aligned with higher risk of repayment? And the answer is absolutely in our first study. And it turns out to replicate in the second study. Things that you can quickly put into like consume without preparation in both the UAE and in Peru, where we did a second study, turned out to be highly indicative of default. In contrast, so what turns out to be like the top predictor of like, are you going to pay things back? It's basically healthy items. So do you buy fresh milk? Do you buy fresh vegetables? Do you buy, beans that have to then be prepared because you have to soak them and then make something with them? So anything you can sort of requires a little bit of work to actually, prepare turns out to be indicative of you're going to pay back your bills. And then the sloppy payment, they sort of mix the two lists, like things that are, a little bit from one list and a little bit from the other list. But it's sort of interesting that your behavior is definitely correlated with shopping behavior, how you shop, and what is that definitely related back to your default on a credit card. And this surprised to us, but when we showed this to people, they're like, "Oh, this is like this must just be like surely you're just spurs." So in the background, you're doing things to make sure that sort of the science is correct. So we're doing this testing and training to make sure itself is valid, that the model is scientifically valid. But the real litmus test is, you know, okay, can you do it elsewhere? Like, is it externally valid in the sense that can you go to another market and replicate these results? And so a company in Peru approached us and said, we've read your first paper. We're super interested in this because in Peru, there is a massive problem of unbanked consumers. Just as an aside, if you're not aware what's happened in Peru, they've been dramatically impacted by what's happened in Venezuela. The population has exploded in Lima. Lima is the largest city, but who has now come into the country. There's been massive immigration because of the crisis in Venezuela. And so there's millions of customers in Lima that don't have access to credit because they're basically fleeing from their homeland. And so you look at the population of Peru and you look at Lima in particular, there are many, many customers who would like to have access to credit, but can't get it because they don't have a credit score. So how do you reach those customers? So this company ended up providing us with access to their data. They were in a similar situation that they're a conglomerate and that they have sort of a banking function that issues credit, and they have a loyalty program. And what's interesting is the reason you can connect the dots here is that in the loyalty program, you will join even though you don't have a credit card because you get benefits, right? So you might get, discounts on milk or discounts on cereal or discounts on rice. So whatever you're buying, you might get discounts and you want to take advantage of that. And so as a consequence, you join the loyalty program. And even though you're paying in cash, we can now identify you. So we get sort of lucky from the perspective of we have all these customers who are paying in cash that are joining the loyalty program. And that becomes like our first piece of data that's super interesting. The second thing is Peru has this open banking system, very different than the US. And so we get access to a credit file that is actually quite thorough. Right? And you look at it and you're like, would that even exist in the US? And the answer is no. So we get access to a credit file that would say, like, here's Eric Anderson, and I can see all of your credit. So I can see not only your credit score, but I can see all your lines of credit. And I get access to like detailed information at, all the loans you have access to, your home loan, your auto loan, and it's all in national registry. So this is shared with all the financial institutions. It's not proprietary to us. And so we use that data. It goes by this acronym RCC. And so we have access to this fairly thorough credit file. And what that allows us to do then is take the loyalty customers, look at them in the national registry and ask, do you have any credit? And there's a huge group of customers that are shopping at this retail store that have no access to credit, right? So they have no credit score. They've never had access to a credit card. And so now we've sort of got part of the ingredients of what we need. But our problem now is we want to score these customers who don't have credit, right? But how do we get a score for them because they need to pay back their bill or not? And we don't have a score because they don't have credit cards. So the third piece, what turns out to sort of get sort of lucky for us, is they start a pilot that lasts about a little under a year in length, where they buy these Equifax scores that are based on repayment of your utility bills. So customers are repaying their electric bill and their water bill and their heating bills, and Equifax constructs a score for them. And for about a year, the company started lending based on that score. So now we can take these unbanked customers and we can look at the population of customers that received credit because of their utility bill payment behaviors and now ask, okay, can we now predict whether or not you're going to pay back your credit card bill? Because now they have credit. So for a subset of unbanked customers, we now get to see, hey, did you have credit? Did you pay your bills back or did you default? And can we predict that using the same approach that we did in the Middle East? And shocking to us, like oftentimes you need to sort of torture the data to get an answer to come out. You sit there and you're like, okay, we're gonna have to do all this work. We're gonna have to come back and like work really hard to figure out what's going on here. We basically used the same approach that I described to you. We looked at how you buy, we look at what you buy. We took the same machine learning model that we built with very few edits and we applied it to the new data. And what came out? Almost the exact same results. So those things that predicted default, Michaela, now you'd be able to say your first choice was correct. What turns out to be the number one predictor of default in Peru? Alcohol, right? They sell alcohol in their stores, and if you buy alcohol, that's the number one predictor. Number two predictor of default? Cigarettes, right? It's completely different customers, completely different market, and you ask, does it predict default? Absolutely. And so we came up with a very similar pattern of results, which is things that you think of as being sort of vices and unhealthy end up being predicting default. Things that you think of as being sort of healthy end up predicting you're going to repay your bills. And so what we ended up working on with that company then was constructing a credit scoring model for these unbanked customers, right? Which we couldn't do in the UAE because we never lent to them. All we could do in the UAE was predict for the people you lent to that were creditworthy, do these habits predict? Now we can advance our findings a little further to say, for customers you normally wouldn't have lent to, that only got these credit cards because of the utility bill repayment behavior, we can now tell you, could you actually have constructed a score for them using their shopping behavior? And that's what we end up proving out. So we end up building that model, walking through with the company how it worked, and we ported it all over to them. We're not in the business of trying to like offer the credit. So they've been actually taking our results and migrating them into their environment, modifying the model, to fit certain things that they needed to do, and putting it into production. And then going out, and what they've been doing for about the last year now is piloting this and piloting it in two different ways and trying to determine can they actually get off the ground with offering credit to these consumers who they normally would have not offered credit to, and using the approach that that I just described to you. And it's not as simple as you might think to just say, oh, you just build the model and you launch it. As soon as you get into the actual idea of doing this in a production environment in a financial institution, it becomes quite complicated. And that brings me to sort of, another point, which is that part of the reason these ideas of, using machine learning and AI to generate predictions fail is not because of the science, it's because of the frictions of the business. And, we experience this full force, which is that these companies need to figure out like, well, how are we going to do this? How do we put this into production? How do we make decisions for these customers because they're normally customers we would reject? Do we need to get regulatory approval for them? There's a whole host of questions you need to go through in thinking about bringing these in. One of them, for example, was like, okay, you've constructed these scores. Do we really want to take on the same risk appetite? Meaning that do we want to hold our portfolio of risk at the same level, and then just add more customers in? Or do we want to do something else, right? Would we like to reduce our risk and only take, customers in this sample that are in this group that are less risky? And so they need to define a business strategy as well to figure out like where do they want to be in this world of offering credit to these consumers. So that all has to be debated with the leadership team on the management side. That's not a science problem. That's a business decision problem. They need to figure out like, how do we want to approach this market? And then the last part, which turns out to be really difficult, is that you actually need to think about how you manage customer service completely differently. So imagine you're in sort of traditional banking, and we all know what happens is, after you miss your first payment, you get a notification through email or through a letter saying, hey, you missed a payment. Then you miss a second payment and bad things starts happening. They tell you your credit card's been frozen, you can't get any more credit until you pay something back. There's a whole process for dealing with you. In this particular market segment, as you start reaching into consumers who are don't have a regular paycheck, you need to be a little bit more proactive in how you manage them and explain to them maybe how they manage their credit, how they use their credit. And so the level of customer service and the nature of customer service is actually quite different. And many large financial institutions aren't set up to combine to present consumers with that or provide consumers with that additional customer service they need. And as a consequence, if you just approve them, you may fail. If you simply give credit to consumers that maybe need a little bit more education, a little bit more assistance, and they also might need a little more forgiveness. Like they may miss two payments in a row because there's a job blip that they've had. And they're going to be back in the workforce. They're trying to get a job, but you need to know that they're not intending to walk away from this. They want to repay this debt. They just are in a bad situation from their job situation that's very short term. And diagnosing that and working with these customers is something that many of the large institutions aren't as good at. And so they need to think about not just taking these AI machine learning models and pushing them right into the system. There's a whole set of complexities ranging from, getting them into production and just getting that to work, agreeing on a management strategy, agreeing on a customer support strategy. All of these things need to come together to be able to be effective. And that turns out to be a real challenge. So maybe I'll pause there and see if there's any questions from the audience, Michaela, things you'd like
Yes.
to push
Yeah,
on a little bit.
we have a ton of questions coming in. I'm going to start with, is there a necessary time period that you need to study an individual for to evaluate their propensity for repayment? And a second part to that, how long does it take before you can get a picture of a person through their purchasing data?
Yeah, it's one of those answers you're not going to like, which is a sort of
Yeah.
it depends. But in our data, we found that we can use, anywhere from like 6 months to a year, and we're fine. We can get a pretty good signal. And there's a lot of the action happens because of this, what's often called a cold start problem. Like the
Mhm.
first couple of payments matter a lot,
Mhm.
right? So if I give you a credit card and you miss the first payment, something's not right. If you miss the
Yeah.
second payment, oh boy, alarm bells start going off, right? And so, it doesn't take that long for you to figure out, like, are they on track to being a regular payer, or are they going to
Mhm.
be, is there going to be an issue? And so we found like, in our studies, we've used about 6 months to a year. Ideally, you'd use longer, but it's very hard in some cases to use longer data sets because just getting this data is already proved to be a challenge. Right. So it's a bit of a bit of a challenge. It's a really good question. How much time do you need?
Yeah, we had another one come in. Can this scoring system be applied to other areas, such as helping small or family businesses showcase their value, particularly when they are ready to sell?
Yes. So as I previewed, I said this has sort of turned into like a bigger thing than I ever thought. So the next big area that we've been working on is insurance. So insurance markets have been calling us and asking like, can we do this in insurance? Like, can you predict risk?
Mhm.
Right? And is it the risk that a customer is going to file a claim, right? Can we do something on that dimension? So we're starting another project that's on the dimension of like in the insurance industry, can we actually understand riskiness of like, hey, you bought an insurance product, right? Are you now going to be the kind of person that actually files a claim? And sometimes those claims are, valid, sometimes they're not valid. Sometimes there's people that are more likely to file claims than others. And so we're using sort of a very similar idea to do it in the insurance market. But I think in general, as soon as you start thinking about risk, you can apply that to all sorts of kinds of risk, right? And you could apply to the example you just described. I hadn't thought about that before today, to be totally honest with you, but it could be like, you want to identify the risk that's out there. And this is just another avenue to identify risk. A lot of what we've worked on though is just identifying risk in personal behaviors, right? So like the insurance example seems very connected or similar to the repayment of your credit card bill. Like it's a different kind of risk. And so like one of the things we're curious about is like, is your risk on filing an insurance claim, is that a distinct kind of risk from your payment of your credit card? Are these two different risks or are they related to each other? If they're related to each other, we can use the score that's used to give you credit to also think about pricing out your insurance policy. Right?
Mm,
And
mhm.
so we can connect the two worlds together. But if they're different, we need to construct a new idea of like, well, is insurance risk different than financial risk and in what ways? Right?
Yeah.
Is it a different kind of risk?
Yeah, no, that definitely makes sense. We had so many coming in, but I'm going to ask another one. How do credit scores impact pricing outside of the US? Do other countries use scores in a similar way when it comes to pricing financial products as we do in the US?
Yeah, it's pretty similar. So I'll give you like an example from one of the retailers I worked with several years ago in Mexico would construct scores for you. So you'd be tiered, you get a continuous score, and then there'd be thresholds. So imagine there's like four groups, right? The
Mm,
lowest group doesn't get any credit, and then the other groups get access to sort of credit, right? And this is the company sold products where financing was just the norm. They would sell you a sofa, a refrigerator, and everyone was financing it. Associated with that financing is a rate. And what you would then pay is a different interest rate depending on your credit score. So the best consumers would pay the lowest interest rate, right? And the ones
mm,
who are more risky would pay a higher interest rate. And so that sort of philosophy that your credit score is determining, do you even get access to credit? So the bottom group here didn't get access to any credit. They could buy things, but they had to pay cash. And then if you had a sufficiently high credit score, you could get access to credit. And then the higher your score, the lower your interest rate. Right.
mm,
And that's very similar in other markets as well, that interest rates are somehow tied back to your credit scores.
mm. Are those identified as the most credit worthy also the most profitable as well?
No. So no. So the most profitable segment, if you go back to the first study we did in the UAE, the most profitable segment is the ones that are sporadically paying back, right? So there's the never delinquents. Those are the ones that always pay their bill, right? Then there's the ones that default and you lose whatever they have on their balance at that point. Those are bad customers. And then there's the sloppy payers. And the sloppy payers are the gold mine
Mm,
because the sloppy payers miss a payment, right? They pay a penalty, but then they get
mm,
back on track, right? And those fees add up, and that turns out to be where a lot of the money is made, is
mm,
with the sloppy payers. Those that come back, they periodically miss a payment, but they end up being good customers financially. They're risky because some of them do eventually become defaulters. Right, but a lot of the money is made for customers that just periodically are absent-minded. They missed a bill payment, they got hit with the penalty, right? And now they're back on track to being a never delinquent, but that payment adds up across all your customers.
yeah. We have so many questions coming in, and I'll ask one more and then I'll let you get back into it. But how can these scores be used by companies that want to provide access to credit but don't have grocery shopping data, such as stores that sell discretionary items?
Yeah, that's a great question. And by the way, before I answer this one, Michaela, feel free to just keep asking me questions.
Okay.
So I have more I can talk about, but there's so many questions I see in the chat that we should just go
Yeah.
through them.
Yeah, definitely.
So one of the challenges with this research has always been like connecting the dots. And so what we've had to do in like more recent projects is form partnerships. And so I think for companies that would like to do this, they're going to have to start thinking about how to partner, right? So if you're an insurance company, you say, oh, I'd like to be able to use loyalty card data to sort of price out risk more effectively. You might need to partner with somebody that has that loyalty data.
Mm,
In the UK, we formed sort of a unique partnership that's going to be right now. It's it's Kellogg and two other firms, and eventually a fourth firm is probably going to enter.
mm,
But it's a nonprofit that provides lending to consumers, right? And so all they do, and they've been doing it for a long time, is making what you think of as microloans to consumers. And they
mm,
do this based on a lot of, sort of self-reported data from their consumers. Their challenge is that 80% of the people that apply for one of these microloans gets rejected. Right? Now, these microloans are very small loans. You might get 50 pounds or 25 pounds. You have to repay it, and you say the time frame you're going to repay and the periodicity. So you might say like, oh, I'm going to take a 50-pound loan and I'll pay it back to you one payment a week for 6 weeks, and I'll repay the
Mhm.
loan after 6 weeks. So they're short-term loans, they bridge you through things. So that's the first firm. We're going to work with them. The second is we're working with the supermarket. They have the loyalty data. And now we can connect the loyalty data with the lending data. And why would we want to do that? The not-for-profit that's making these microloans would like to expand the number of loans they offer. They feel like they don't have a really good read on, they're conservative in how they're offering these microloans because they have to be self-funded, right? They offer zero interest to their clients that get a loan. And they make all of their money off of the donations that they receive to fund the infrastructure and the defaults. If they have too many defaults, they go out of business, right? They can't make loans. So they would like to be able to offer more loans, but they can't take on a lot of risk. They need to know, are there customers in that 80% that are low risk that we're missing? That's their question, right? So bring in the three-party partnership of Kellogg, not-for-profit, grocery store. But then the question is, well, what's next? Now we're going to bring in a fourth institution, hopefully a big bank, and offer credit and be able to go back to a formal lending institution and say, here is a customer that now has a demonstrated pattern of repaying their loans, and we can put a credit score on them using their
Mhm.
past behavior, and we can hand that off to a lending institution to get them access to formal banking. And
Mhm.
that's the project we're working on right now, right? Is to try and sort of bridge that entire gap of show how you can actually not only use this data to construct a score, but the process by which you would actually get people access to formal credit. So we're doing that in Europe, and we're also, trying to offer credit using our approach in South America, right?
Mhm.
Similar kind of idea. But I think the ultimate litmus test for all of this is figuring out how you can get into these markets. And I think the European example gives you an example of you don't need to be a conglomerate. You can just form partnerships, right?
Mhm.
So by forming these partnerships, the big financial institution is not going to become a supermarket. They don't have the loyalty data, but they're going to form a partnership to get access to that. So that's how we're solving the problem.
Yeah, we have a couple of questions about AI. And so, how does AI impact these studies? Would this study have been possible 5 years ago?
I'd say no. And so the reason I would say no is that I'm going to hopefully not get too technical, but maybe I'll just get you to visualize an Excel spreadsheet.
Yes.
Okay. So think about an Excel spreadsheet and suppose you had, 100,000 rows in your spreadsheet, right? So traditionally, when you think about like building a model, you think of it as like, oh, if I have 100,000 rows, I can't have that many columns. In fact, typically you think about the number of columns of data you have has to be smaller, substantially smaller than the number of rows. In this data set, it's not, and if it was, think about it as being very skinny and long visually. Just like you
Mhm.
go, oh, I've got 10 columns and they go down 100,000 rows.
Yeah.
Our data looks exactly the opposite. So our data is wide, like
Mhm.
really wide, because we treat like every time you buy a product like cigarettes, it's not buying the category of cigarettes. It's like, did you buy this brand of cigarettes? And did you buy, like, we have very detailed data. And so the data set ends up being sort of violating a rule of like how you'd actually estimate a model, right? So traditional statistical approaches, you sort of have to decide on, okay, I've got to cut my variables out and make it look skinny again. That's sort of the general idea is you take a wide data set and you eliminate variables, say, oh, these are the only relevant variables. But you lose all the insight that could be coming from the ones you cut out. With the machine learning and AI approaches, they deal with this dimensionality really well. You don't need to do this. They will find patterns in the data and show that these aren't spurious. And so that's where this whole idea of the machine learning model will ends up being like super advantageous is it deals with data that is really wide and it also deals with data that's also very sparse. Right. So
Mhm.
there's been lots of improvements in the computer science world to deal with these challenges. And while we had solutions before, the solutions on the computer science side tend to be way better. So that's where these AI machine learning models benefit from just data side. And then the other thing they benefit from is massive flexibility. If you have a large enough data set, these models generate flexible relationships that you otherwise couldn't find in your
Mm.
with a statistical model. I'd have to specify, for example, sort of complex interactions that occur in the data, whereas the machine learning model sort of just discovers them automatically. Doesn't need to be sort of informed by my, intuition as a researcher. The model just finds them. And so for us, the AI and machine learning models, I think a lot of this, we could have done it, it just wouldn't have been as good. Right. And
Yeah.
so the models end up being a lot better because we're using these more advanced approaches. We do benchmark ourselves against sort of statistical models in our papers just to show that you do get some advantage.
Mhm.
But they matter a lot in these contexts where you don't have a really we face some of the challenges I just described.
Yeah. We had another question come in about personal consumption. It's what is the likelihood that regulators, at least in the US, will be comfortable with letting people's personal consumption preferences be used to evaluate their credit risk?
I think that's going to be a big question.
Yeah.
That not only so there's maybe two parts to that question. One is could you use these consumption behaviors for credit risk, and then the other is could you use an AI model? So right now you can't use AI models in lending. Like it's
Mm.
not in highly regulated markets, you're not allowed to use them. There is a workaround, right? So what you end up doing is you end up using an AI model as a benchmark to say like, hey, this is the AI model's version of risk, what it predicts for
Mhm.
risk. And then you use what's called an analyst-driven model that can be approved by regulators to say, well, how close to that can we get? Can we get
Mhm.
reasonably close to it? And so that's sort of the workaround that firms would use is they would use the approach that's been approved and keep modifying it to get closer and closer to this AI model benchmark and say, that's my goal.
Mhm.
And so both of these are big challenges, right? That the model itself it has to be approved by regulators, but
Mhm.
also that includes the variables like these behaviors in them. But with that said, it is being used in other markets, right? So
Mhm.
in Western markets. So I can tell you that for sure there are firms that make approval and denial decisions and uh, manage their portfolio of risk using these alternative data sources. It's definitely happening today. So it's not that it's not allowed. It's been approved in markets, and there's folks out there that are trying to develop lending models around this.
Mhm. Yeah. We still have so many questions coming in, but I'm going to go to one with about purchasing data. Can this purchasing data be used to help those limited hi- with limited history gain access to credit?
Um, yeah, I think the question is like, you know, let me just go to like mindset of being in like Lima, Peru,
Mhm.
and you're a new immigrant from Venezuela that's, found a job and you're working, you've got some income. It's sporadic, but you don't have any history, right? I think for us, what you'd need to have is a loyalty history of a few months of data. So we need to see your shopping behavior for, you know, 3 months, 6 months. At that point, I can score you out, right? I don't need to offer you credit. I can score you based on your shopping behavior to say, oh, I've got a model that I've already trained that's built with other customers. And with a few months of your own data, I can now score you out and get a credit score for you and then determine whether I want to lend to you. Right. And so that's definitely possible today. And so I can't do it after 1 week, right? I
Mhm.
need I need a few months of data to be able to calibrate to create a score for you, but it's not years of data, right?
Mhm.
So that is our hope is that firms can actually start using, training the model the way I described, but then using it on customers who might be needing access to credit.
Yeah, definitely. How do you think these scoring models will impact new credit companies such as Klarna, or excuse me if I'm saying that right?
One more time on the question.
How do you think these scoring models will impact new credit companies?
So, like, there's a whole fintech world out there of like new companies out there trying to
Mhm.
provide credit in new ways. And I think um, this is just part of that space, right? I think this is
Mhm.
not unique. In fact, as soon as we've written these papers, lots of companies have been calling us. There's lots of firms out there trying to figure out how you can be scoring customers in unique ways. So let me give you an example. So this is a company that calls this, and this one just blows people away. Okay, so um, what they do is this is a company that helps authorize, think of it as retail credit. So, you might think about a retailer that has a site, you have an app as a consumer, and you can get a store branded credit card, right? So it would come with the retailer's name. I'm purposely not going to tell you the name of the retailers that they work with. And so you've got this app for a retailer, and they tell you on the app, hey, would you like to get a credit card? It's a credit card for our store. So it'd be like getting it's not Apple, so I'll use Apple as the example. It'd be like getting an Apple credit card, right? It's branded as Apple, right? So these would be branded by the retailer's name. So you go into the app as a consumer and you say, hey, I'm Eric Anderson. I'd like to get your credit card. And you start typing out and you fill out your application. Now, as soon as you start filling out your application, all that information is transmitted to the cloud. Everything that you type, the speed with which you type, what you type, as well as you've clicked a box to give them access to various pieces of information on your phone. All GDPR compliant for those of you worried about privacy, right? They suck off all that information, and then in a matter of a few milliseconds, they give you a credit score they give a credit score to the company, and then they deny or approve your card, all based on your behavior through the app. And you might be asking, like, how much data do they have? They generate what they think of as a million variables in their model, right? Because they're crazy things like the speed with which you type, right? How quickly do you move from one screen to the next screen, right? There's all sorts of things that go in there. But the craziest one of all is they can download a signal that tells them how many photos you have on your phone and how many of those what percentage of those was the camera facing out versus in. And when it's in, it's a selfie.
Yeah.
The percentage of selfies is highly correlated with default. And so it turns out that if you have a lot of selfies on your phone, you get denied. Right. And so they're like, yep, we can tell you all sorts of things that are happening. They can also look at things like, oh, you've got this application open, but by the way, I can see on your phone that you've got 4 other applications open that you're looking for credit. That's also a terrible signal. If you're looking for credit from 4 different companies at the same time and shopping for credit, trying to get a retail credit card from us, but also credit cards from other companies, you're probably a high risk customer. So all of these things are sort of like this world of fintech, of firms trying to figure out, can we actually help out and construct scores for lending in new ways? And the cell phone one to me is like the craziest one I've heard so far. And it's not hypothetical. They're doing it. It's like it's happening. It's none of it's happening in the US. It's happening all outside the US, but it's happening in other markets. But I think we've now talked to people across the entire planet, and everybody's working on this problem, whether you're in Africa or in South America or in Europe. In the US, we've seen it. So it's been something that's been across the world. And that's, I think, was a big surprise to us, is how pervasive this is, that everyone's interested in this problem. I did see a comment come up saying that it looks like this is mostly benefiting businesses versus consumers. I think it's a fair point that you have to think about the risk here as who's going to benefit. But I wouldn't come back from this and say that this is about benefiting firms exclusively. I think this is one of these situations where if it's managed correctly by the firms, maybe by those that provide oversight, it can benefit everybody. It can be beneficial to consumers. And until you hear the stories of consumers who need access to credit, and I'll say fair access to credit, like affordable access to credit, you really don't get to hear sort of appreciate the consumer side of things. And for me, the stories that we heard from the UK are just heartbreaking, right? People that can't buy food for their kids over the summer because they're on summer break, right? And you're like, yeah, how do you solve that problem? Obviously, you don't want to charge them outrageous interest rates, right? They can't afford that either. And so there's a sense of equity here that the firms have to have. And I think if you don't maintain that, you're going to be in trouble. I think you have to view yourself as, yes, we're trying to do things that are sound financially from a business perspective, but also do things that are responsible for the community, right? And so I think how firms approach this is really going to be the answer to your question of, is this benefiting firms exclusively at the expense of consumers? It could. Like this, there's no question. There's risk here. right? That it could be all one-sided. I think that has to be managed by both the firms responsibly as well as by overseers and regulators to make sure that doesn't happen in a way that damages, consumers and hurts consumers.
Yeah. Related to that, what are false positives and false negatives for a model like this?
Good question. I mean, there's that happens in every model,
Mhm.
right? Where, you give credit when you shouldn't have, right? And what does that turn into? That's unexpected, like unexpected default, right? And then there's people that you deny credit to that you should have given credit to, right? And so those are the things you're worried about. And actually, that comes back to, interestingly enough, that becomes back to sort of the philosophy of the firm, right? When you think about your strategy, how do you want to, like, you may want to tune this model and adjust how you build this model to deal with those false positives and false negatives in different ways. Like we treat them in a balanced way. We don't care about the errors. We say like either error is okay. Like we're not going to treat one different than the other. But you might want to treat one differently. You might want to say like, oh, I care more about missing out on customers that were really good risks versus, I'm willing to take on a few more false positives where somebody was given credit and I should not have given them credit, right?
Mhm.
And so, I think this is just a question of like, how you want to build your model. Like there's a sort of a
Mhm.
science question, but it's also a question of how do you want to approach the market? Like what's your tolerance for risk on both sides?
Yeah, and keeping with the models, what's the agility of these models? Are there key predictors often reevaluated? For instance, if selfies correlate to default risk, when and how does a more powerful variable take precedent?
Yeah, that's a great question. So I think everyone's got to constantly be asking themselves, like, it gets back to this question of, are you building a product or are you
Mm,
building a system? Okay. And
mhm,
that's what also is affecting the implementation of our model, right? Why it's taking so long. We built a product. It's a proof of concept. You can create a score. But in production, you have to also have a decision which you say like, okay, are we going to update this every week, every month, every 2 months? What data feeds are going to go into this? What's the process going to look like for this? All of that has to be laid out. So it's a very different question to say we've built a proof of concept that you can do this versus I've productionized this in a real environment where you're going to say, yeah, we're doing this over and over again. In that system, this is where you might discover like, oh, selfies are really important right now, but over time, like that becomes less important. It's about typing speed becomes more important. And so the system's got to be able to adapt over time and decide, what are the current weights? But that's all part of how you build a product, right? That's a different question. We don't get into that because we're not commercializing our
mm.
solution here. The
Yeah.
company has to decide how they want to commercialize this.
No, that makes sense. We have about 5 more minutes, so I'm going to try to get through some more of these questions because we've just had so many come in. But in the US, lenders are required to explain the reasons why a consumer did not receive the best possible terms slash credit line. So how do you follow that rule if you say you would not want to share these decision points?
So, just as a starting point, if
Mhm.
you ask somebody how your FICO score is created, no
Mm.
one will tell you, right? Just that point blank. They will not tell you how your FICO score is created. People speculate all the time. You can read about how FICO scores are created, how people believe your FICO score will go up and down. Some of it might be correct, some of it may not be correct, but my FICO score moves around every month. I have no idea why it's moving around, right? Now, there's certain things you do know, which is you miss a payment, you default on something, your score goes down, but I have no idea why it's going up and down on my behavior. That's my own personal introspection. You are completely correct that models in the US have to be explainable, which is why I said that these AI models are not allowed to be used in production. That you
Mm.
can't use them in production, you can't use them to authorize credit, but you can use an explainable model to a regulator, not to a consumer, but an explainable model to a regulator on the side is the main thing. Then you benchmark it against the AI model. And as part of that explainable model, right, you can put in your FICO score, right? So there's nothing wrong with saying like, well, the reason you were denied your loan is because your FICO score was 530, right? That's not out of bounds. I think what's going to be a question is how regulators might react to scores being informed by behaviors they're not used to, non-financial payment behaviors, like what you buy and how you buy. That's a hurdle that you have to deal with, and that comes back to my earlier comments where I said, why is it taking them so long to get this implemented in Peru? You may need to get regulatory approval on certain things. Like you may need to get regulators to say, yeah, we've shown that we are comfortable with you using these scores. But I don't think you need to share all that with consumers, right? That's just shared with regulators to say, yeah, this is all above board. It's not something that is, deemed too risky. But the regulators often care about is the risk you're taking on, right? Are you managing your risk appropriately? And are you doing anything that would be viewed as biased to consumers, like denying loans based on race or age or some other factor that they would not deem as being acceptable, right? But that's why I think it's a easy task for us as researchers to show this proof of concept. The
Mhm.
actual implementation requires a lot of hurdles you have to get through. It's not a simple task of just saying, "Yep, go use this approach."
Right. Yeah. Well, I'm going to end it with one last question, and it is your data publicly available? And if so, where can we find the publication and how can we learn more?
Sure. So great question. All of our papers are publicly available. And so you can get them either through the Kellogg site or if you email me directly, I can send you the copies of the papers. So those have all been published. There's a place called SSRN where you can find all our papers. That's a public site. You can find all sorts of interesting, nerdy academic papers. And so all of that's out there. Our data, for obvious reasons, there's no way that's going to be public. So neither company wants us to be releasing our data publicly. So we don't reveal any of the data that we have.
Yeah.
And we also don't reveal the algorithms because they're also interested in those. So the most you can learn about it is from what we describe in the papers. That's all been approved by the companies for us to release, to talk about publicly. Um, but if you want to know more, I can tell you about the other projects we're working on. So as I said, we're working on this not-for-profit, working on, a project I didn't mention, which is working on, how much does it change your shopping behavior once you're a first-time credit customer? Like, that's an interesting question. You got a credit card for the first time. What do you do? Like, how
Yeah.
do you shop differently? So we're answering that question. And then we're doing stuff in the insurance markets as well, sort of thinking about how it affects can we use these same approaches for pricing out risk in insurance? So
Perfect. Well, thank you everyone for joining us today and for all the questions that came through. Thank you, Eric, for your presentation and answering and participating in This is Kellogg. This was such a fascinating discussion.
terrific. Thanks, everyone. Appreciate it having
Thank
everyone here
you.
today.